inflation is really starting to show up in the U.S. economy. For those that have followed it closely, our clients, for instance, we put out a video last fall talking about, the biggest paradox right now in fixed income investing is the concern that over the course of the next 8 to 10 years, your fixed income portfolios, your bond portfolios, could potentially lose spending power. They might not lose value in terms of absolute dollars. Your $1 million account could still be a $1 million account 8 years from now. The unfortunate part is 8 years from now, what you could buy today for $1 million might cost you $1.4 million or $1.5 million 8 to 10 years from now, because inflation has the potential to run higher than it has been over the course of the last 20 to 30 years. So we're starting to see the impacts of that show up in the U.S. economy. The last month's what they call CPI print, Consumer Price Index print, showed inflation running about 4.5%, 4.6%, I think was the actual number. That's about 2 to 2.5 times what we've averaged in inflation over the course of the last 20 years. And there's a lot of reasons out there for it. Probably primarily, or the reason that's getting the most focus is the government spending that's been going on for the last 12 months. Go back to the initial impacts of the coronavirus. One of the things the government did very quickly to help the U.S. citizen, to help the U.S. economy, was send out stimulus payments directly to individuals so they had money to cover rent and food for people that were put out of work. They also put a number of programs in place to help employers keep employees during that time period. Since then, there's been a number of additional programs that have gone on, somewhere to the tune of about $6 to $7 trillion so far in the last year, that the government has now put new dollars into circulation in support of the U.S. citizen and the U.S. economy as it relates to coronavirus. And going forward, there's two proposals out there that could add another $4 trillion of spending to that. One of them being an infrastructure program, another being a program focused on the American family, college education, childcare, things like that. So if the government is going to spend money like that, money that they have to borrow in some way to spend, and you push those dollars into the system, it can lead to inflation. The other thing it can lead to is it can lead to a devaluation of the US dollar. As we spend more money that we borrow, the rest of the world looks at us and says, maybe your currency isn't as strong as we think it should be, and we start to change the pricing of our currency. So our currency goes down in value relative to other currencies. Well, we import a lot of goods. If we're importing from countries where their currency is staying stable and ours is going down, the cost of everything we buy from them goes up in value. That used to be most obvious in the oil and gasoline sector, because we bought a lot of our oil and gasoline from the Middle East, or the oil in particular to make our gasoline from the Middle East. So when our dollar went down, the price of gasoline in our country always rose in direct correlation to the value of our dollar going down. We're a little bit more energy independent today, so we don't see as much in the price of gasoline, but we're certainly seeing it today in the price of lumber. We're seeing it in the price of wheat. We're seeing it in the price of corn. There's so many commodities where we've seen dramatic price increases from a year ago. Lumber, for instance, if you were to go into Home Depot today and buy a sheet of plywood, that piece of plywood is costing you 4 to 5 times more than it cost you just 1 year ago. That inflation, many people believe that inflation is here to stay. Only time will tell. I talk to people in the building industries that say that now that they've driven up the price of a 2x4 or price of a piece of plywood, it's very unlikely that you're going to see concessions given back on those price increases, that those price increases are around to stay. So it is a big concern for us as investors. One of our goals is not only to help you grow your money in absolute terms, but it's to help you grow your spending power, which means growing your returns in excess of inflation, so that you can not only keep up with inflation, but as you save money, as you invest money, you have the ability to, expand your ability to spend money. And really that's how a person typically funds their retirement, by not only growing their dollars in absolute terms, but growing their dollars in terms relative to inflation and relative to spending. So that is something we're going to be keeping a very close eye over the next 4 to 5 years, but probably in hyper mode over the course of the next 12 months to see what happens with inflation and what do we need to do with our portfolios to accommodate it.